Hi, I'm Grant Cleary, Principal of Cleary Wealth Management, a boutique advisory firm in Auckland. Tonight I'll be presenting this year's episode of our State of the Nation annual series, and the topic is Bulls, Bears and Volatility, a Confused New World. I'll be looking at the markets since November 2016, which coincides with the election of Donald Trump, and the subsequent extraordinary run of those markets to the end of January this year, and since then the subsequent return of volatility. This volatility, I think, is a far better reflection of the world than the rampant performance of the markets previously, and I'll look at the state of the world. Lastly, I'll make the case that this environment is a perfect situation for a rational investment strategy such as the endowment model, which is the one that we use and advocate. I hope you enjoy it. Good morning, everybody, and as Douglas Adams famously said, thanks for all the fish. The topic of tonight's soiree is on the board, and it is Bulls, Bears and Volatility. It's a confused new world. Disclaimer, blah, 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 blah. And then the proper disclaimer, which looks very similar to last year's from Yogi Berra. The future still ain't what it used to be. And it's still tough to make predictions, especially about the future. So bearing all that in mind, this is today's presentation. Could you bring in that list of risk factors, says investor, that you were downloading yesterday? And the answer is, it's still downloading. So today's presentation is approximately about this and what we are trying to do about it. With the exception of 2011, the capital markets have enjoyed an almost surreal run of good returns from March 2009, which is when the GFC apparently finished. It's my submission to you that that finished late January this year, and what I will look at tonight is why that is a good thing and what's next. So, what I aim to do tonight is present the case that while markets appear overwrought, mortally wounded, and look like dead men walking, the opportunities for making above average risk-adjusted returns have arguably never been better. For the next 40 to 45 minutes, I will look at what capital markets have done over the last 18 months, particularly, and why I think that's a fool's paradise. We will look at what I think the world looks like today and why there has probably never been a better time to invest. Despite Trump, populism, the Middle East, unprecedented debt levels, worldwide climate change, blah, 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 the capital markets have operated in an absolute reality vacuum, with equities getting ever more expensive every day, well, certainly every month, while bonds keep getting bought at ever more ridiculous yields. Volatility, meanwhile, died. Reality had to intervene eventually, and it did. Last year we looked at the world now trumped. Politically and socially and all sorts of other things, it appeared to be stuffed. It was then, and let's admit it's worse now. We will have a look at that. And portfolios need to be designed to take advantage of all opportunities and to be resilient to shocks. That's what, now's the time to have sensible portfolios. So, the real world since 2016. Populism, rampant everywhere. Certainly in the white continents, except perhaps for Antarctica. Economically, a trifle odd, to say the least, typified by what's going on at the moment. A combination of the art of war, except this time it's the art of the trade war, meets the art of the deal, Trump's famous book. Socially, dislocated, fundamentalism's rampant inequality, both nationally and internationally, continues to grow. Refugee numbers rise by the month. Terrorism visits major white cities regularly. It's a mess. Climatically, out of control, and arguably ignored by the biggest polluter. If you consider countries, it certainly is, but the biggest polluter in the world is actually California, and they are actually addressing things. So, the capital markets are obviously a reflection of reality, so they'll be a function of the above. I wonder, are they a reflection of reality, or is it a view through the looking glass? I think this probably sums it up. 'Twas brillig in the slithy toves to gyra and gimble in the wabe, said Lewis Carroll, and that makes far more sense than the markets, in my opinion. We are through the looking glass. So, equities. We had a perfect year in both the United States and New Zealand. A perfect year is one where every month the markets had a close higher than the previous month. That had never happened anywhere in the world. In both countries, it actually was more than a year. It started in 2016. Never ever happened before. If you remember last year, I had this graph up. We had 9 days in a row early last year where the Dow hit a new all-time high every day. This stuff does not happen. The Dow actually finished at the end of 2017 with 9 quarters in a row of growth. It just is impossible. It doesn't happen in equity markets. The markets are priced for perfection, and possibly a little bit more. They're more expensive than 2007, but in 2007 everybody was worried. Nobody cares now. Equities have been bought to generate income, and the reason you do that is God knows why. Equities are a growth asset. And the world has become valuation agnostic yet again. You use the 10-year to discount, or maybe you use the cash rate because the 10-year now doesn't work, or you use imagination, desperation, or prayer. You use growth multiples, or it's all about momentum, or, my personal favourite, has been for years, this time it's different. And we can all sing along, it's never different. And the bull market, it's now the second longest bull market in history. And it's interesting. So our guy is the green guy. If you have a look at the red one and the blue one, which are the longest and the third longest, you will see that they look remarkably different to the green one. The green one has just kept going up. Even the longest one had huge periods of volatility. The third longest one, very volatile. That's how share markets behave. The thing we've got at the moment is just a steady rise upwards. We had the blips with the taper tantrums, a couple of other things, but in the main, this has been a ride straight up. And after equities, of course, we've got bonds. Risk-free return, apparently, the intelligent market. It's where all the geniuses from finance school go to. The backdrop to the bond market. QE is dead. Long live QT. Everybody know QE and QT? So, this here, what's that? Anybody? Quantitative easing, sometimes called printing money. It is unconventional economics. It is where central banks start buying bonds. They start buying assets that aren't part of their purview. We saw the US take on $5 trillion of extra assets. I'm old enough to remember when $1 trillion was a lot of money. Now, what is QT? Nev? Quantitative tightening. This is when banks that have indulged in quantitative easing then start loosening up their balance sheets again. Now you think about this. Seats up here, mate. Just rush down the outside. The US Fed has got $5 trillion of excess asset. They aim to start dumping this. And in fact, they have started. And the reason that we're getting into seeing the end of QE and the start of QT is we sort of have inflation. And the reason we sort of have inflation is because all the signs are there, but it's not yet monetized. However, central banks will act to avoid inflation. So interest rates are heading up. So now you can buy bonds for income and not growth, because people started buying income assets called bonds because they would go up in value when interest rates fell. Again, interesting. But guess what? Here we are. This is the S&P 500 dividend yield. It's been a steady 2%. This is the US 2-year bond yield. So it's comfortably higher now than the dividend yield. And this is only for 2 years. So it's come up from, in this graph, from 1.2% to 2.4%. The yield's doubled in a year. That's what's happening to interest rates. It's a funny thing buying this, dividends, for income. There's a very big exchange-traded fund called the Dow Jones Global Dividend Income Fund. We have prizes for questions tonight. The Dow Jones Global Dividend Income Fund is the biggest ETF in the world that doesn't reflect an index. What it does, it buys high-paying dividend stocks that are stable in nature from all around the world. The New Zealand and Australian share markets combined make up somewhere between 6 and 8% of the world's market capitalisation. What percentage of the Dow Jones fund came from Australasia at its peak? 20? What was the last one? That's too high. At the moment, 20 is in front. Who said 32? Pass that book back. We really do have prizes. For those that came to the CRG meeting the other day, you would have heard about Phil Houston, the ex-CIA guy who put together a system in the CIA to identify liars. And CRG have generously sent us a pile of his books. I've read it, it's pretty good. Yes, at its peak, 36%. So 1/3 of the biggest ETF in the world that's not an index came from Australasia. How stupid is that? How dangerous is that? So, you can potentially be more risk aware these days, which is a very good thing, and not chase return up the risk scale. Yay! Normal is the new beige yet again. Yeah, maybe sort of no. I don't think so. Because we've got a few examples to prove that the reality is the world's an idiot. First example, the Argentinian 100-year bond. It pays 7.9%, fixed for 100 years. Now, if you've got a good memory, you'll remember when mortgages in New Zealand were more than 7.9%. In fact, there's people in this room will remember mortgages that were 20%. And you get you're going to lock yourself in for 100 years at below 8. They looked for, as part of a $16 billion issuance, $2.75 billion in this 100-year bond, much to everybody's surprise. But what was more surprising was that it was overbid by 3.5 times. By 2.5 times, which is extraordinary. And here's the thing that should draw your attention. It was issued 1 year after Argentina rejoined the bond market. Now, you might not know what that means. So if you Google up Argentinian 100-year bond, you will get a little notice telling you that there's 2 million and something entries on it, because it is pretty good. And you get things like demand for surprise 100-year bond, and the rush for a 100-year bond from Argentina maybe indicates an investment bubble. But it also tells you what else people have searched for who looked for this. One of them is Argentina's debt default. Twice in my career, Argentina's defaulted on its bonds. Said to its creditors, go forth and be fruitful. Now, a lovely gentleman called Macri, who is their new president, and he is a hero of Argentina, a modern hero. He paid back the last set of bonds, and didn't just pay back all the principal, he paid back all the interest, which amazed everybody. So a year ago, or in fact in 2015, they rejoined the world bond market. They were able to access cash through the bonds, which is interesting. We'll see what happened later on. So, the world proved it was an idiot in other ways. Bonds remain irrationally expensive under every single measure you could possibly consider. Let's look at this. In February 2018, the US 10-year government bond yielded more than New Zealand. First time ever. No offence to New Zealand, but you're kidding me. That means that New Zealand is more expensive, is a better a place to put your money from a security point of view than the US. It gets better. The US 2-year yield exceeded Greece's in the same month. Now, God save me, the Greek 2-year, 2 years before, was at 16%. Nothing's changed. Now, I've seen arguments that in Europe, Greece is entitled to have a 2-year yield round about where Germany's and France's and everybody else is, because they use the same currency. It's bollocks, but at least it's an argument. Those that with a reasonable history of what's going on will know that the US does not use euro as its currency. It has its own. The market today is pricing in 3 Fed funds rate increases in the next 2 years. This is despite the fact that the Fed is signalling 6 or 7. Now you might go, so what? Well, if the market expectation is that the Fed funds rate goes from about 163 to around about 238, and the reality is that it's actually going to go from 163 into the high 3s, you've got a problem, because eventually the market will go, shit, that's over a lot. And all your pricing of other assets has to be changed. Every single Swiss government bond, up to and including 10 years, is still yielding a negative interest rate. Every single one. That's a little odd. Just think about that. there's still, of all the bonds, the government bonds in the world, 15% are still paying negative interest rates. How distorted is that? Today in Sweden, dig this, depositors are paid -1% for their cash, but even better, mortgagors pay minus 0.75%. You take out a mortgage and get paid for doing so. Do you think that that might be a little unreal? And still there's more. There's corporate bonds, which are, I believe, even more irrationally priced. Worldwide, banks have issued things called hybrids. They're lovely for the banks. And they make the regulators happy, so everybody wants to make a regulator happy, so let's congratulate the banks and ignore the reality that this is sub-equity debt. That means that in a capital stack where a company works out what it's worth, at the bottom you have equity. That's the money that the shareholders have put in, and it has a value. Above that, you have preferred equity, which is shares that pay a fixed coupon, and they rank ahead of the common stock, which is the first stuff. Then you have debt, which ranks from senior to junior. And the senior is the first out, and da-da-da-da-da-da-da. These things, the banks have the choice between paying you interest and paying you back ever. And if you listen to sell-side salespeople, they will tell you, oh, but with National Australia Bank, for instance, there's $50 billion of equity between you and that happening. We'll take out that condition then and just call it a bond. No. So you can decide not to pay me interest or never pay me back ever. Yes. Who'd buy it? And yet these things trade at a premium. Worldwide, corporates issue debt despite the fact that they've often got gigantic cash balances and that their equity is considered badly overvalued. And in many cases, both. So why would you issue debt? It's because they sell it, and that's what you're doing. You're selling to people the fact that you're going to pay them a rent on their money. And the rent that you're going to pay them on their money, which from the lender's point of view is called interest, is so small that they'd rather borrow than either use their cash or sell you equity. Think about that. Investors continue to buy bonds when in many cases the interest rates of the bonds, and the bonds can never grow in value by the time they reach maturity, right? So all you're getting is the cash. And there's infinite examples where this stuff has been issued, and if you'd bought the shares, you would have got a higher interest rate. How good is that? So you had Nestle, when the Swiss 50-year bond went negative, Nestle, a Swiss company, went, I wonder if I could get away with that. So they issued a negative coupon bond that was 3 times oversubscribed. Work that out. We now have people called yield agnostic investors. Pronounced idiot in many languages. In small stock exchanges, brackets, maybe the one we have here, close brackets, you have low risk securities that we call listed bonds or listed all sorts of things that are almost always less liquid than the higher risk security, the growth security, which are called shares. I have seen liquid portfolios filled with stuff where the trading is often nothing in a day. So if something happened and you wanted your money out and you had a liquid portfolio, you might be stuck with this stuff until you discount it rapidly. We had somebody last year that had a pile of this stuff, and they said, what should I do with it? And I said, well, burning it's probably a start, but we go try getting rid of it. We did an analysis. It would have taken 3 months to sell the stuff. 3 months. You're kidding me. It's just terrible. People can't do arithmetic. That's the thing. People don't think. So, the reality with bonds, if we agree that the world's proved that it was an idiot, do we have risk-free return? No. What you're buying is return-free risk. You shouldn't own $1 of bonds in this environment. Interest rates are going up, which means the value of your bonds goes down. You should not own $1. And then on to my favourite subject, volatility. I spoke at a volatility conference in Sydney a few weeks ago. And if it had been in January, everybody in the room would have been very sad. There would have been no investors, and all the volatility fund managers would have been drinking water because nobody would have been interested in their product. We'll find out why they were actually all very happy later on. But this is why they were all sad. In 2017, volatility got killed. So these are both bond vols. The top one is the US 2-year Treasury, the bottom one is the 5-year Treasury. This thing here is just the 5-year average of how volatility works in this. Now the 5-year Treasury itself is one of the most traded commodities in the world, and yet the vol just disappeared. People just went to sleep. Interestingly, the 2-year vol, which back in the day had lost vol completely, has been quite volatile. It was the one asset in the US that kept high volatility. But the one that I keep talking about in the clearance is a thing called the VIX, which is a measure of equity volatility. Now this needs a little bit of explanation. These bars up and down are standard deviations. So that's one standard deviation up, that's one standard deviation down, that's the mean. Now if you're quite good with vision, you will see that the average is 20, and of late, in 2017, this thing was trading below one standard deviation almost the whole year. Up till April last year, the VIX had closed below 10 a trivial number of times. It's closed down there since almost 50 times. The world went to sleep. We've been warned many times about forgetting the past. And yet, the past in this case isn't that long ago. Look at these spikes. 80, 41, 45. This is since 93. And this number down here, that's about 12 or 13. Last year, at the time of this, 962 was a low. It's been lower than that several times now. It's just crazy. If you ignore the past, you are doomed to repeat it. And one of the things about vol, before we get on to that, this is what happens when vol is low. This was late January. what happens? You extrapolate from the recent past. The bane of my existence is recency bias and extrapolation. Look at this. And it's not just a record high by a little bit, it's a record high by miles. So more than 50% of people were certain that equity values in a year's time would be higher, despite the fact that equity values were at a record high anyway. Sigh. And you forget, this is on on semi-log, and it goes way back to 1990. Now, if, again, you're blessed with a miracle of vision, you will note that every patch of low vol follows with a patch of high. For every up, there is a down. For every down, and up, as the song goes. Low vol always ends spectacularly. But perhaps this time is different. Ah, yes, we actually got vol last year. This is the Kiwi Kopek for the last 12 months. The New Zealand dollar, that's a 10% trading range. Now try and draw a line of best fit through there. Does it go through there? Does it go up there? Does it go across? It's utterly random volatility. Imagine being an importer and trying to work out what the hell you do with your forwards. It may be Alfred E. Newman was right. Why worry? Or maybe he wasn't. We are, after all, through the looking glass, and there's always a Jabberwocky through the looking glass. Let's look. All good stories have a denouement. And this year's was a beauty. It's got a very dull name. It's called February the 5th. And it was bought to you, actually by the Jabberwocky. Fancy that. Actually, that's clearly nonsense. It was brought to you by that thing. The number 3. If you've got a good memory, you might have heard me mention the US 10 years a few minutes ago. If the market is right, the US 10-year Treasury yield doesn't get near 3% probably this year. In the last week of January, early February, it hit 295. Again, if you're quite good at maths, and if you're not, talk to somebody next to you that is. 2.95 is remarkably close to 3, and it got to 2.95 from 2.28 in a matter of weeks. And this happened. This is a very interesting graph for people like me that get interested in graphs like this. It goes right back to the GFC. And this here, this line is the average of long up here, VIX positions versus short VIX positions. Now, as you can see, while quantitative easing was in and interest rates were held low, we had no volatility at all, and the market kept betting that vol would not just stay low, it would get lower. So at this point down here, we had a record number of short volatility positions. Now look at that. That's called February the 5th. That's in here, that day, funds that invested short in the VIX managed to crater 85% of their value in 4 hours. If you annualise minus 85% over a year, it's not a pretty number. And they'd already lost 11% between here and there. So they were down 96% in a matter of days. One of the biggest investment banks in the world, a thing called Credit Suisse, had a fund literally with billions in it. They closed the fund there, sent a letter to their client saying, quite literally, I'm sorry, and the fund's closed and here's 4 cents. Thanks for coming by. Which is blindingly obvious that something like that was going to happen. And when you actually see what it looks like compared to other days of sudden volatility, it really does stick out. So there's your line of best fit. There's everybody, there's all the other really bad days. And there's February the 5th. That was the single biggest percentage change in the VIX in history in a day. And it got people worried. Well. And the reason that this was so big and so shocking was that even though markets tumbled, lost 10% in a few days, that's not a big move. It's just that the market hadn't seen anything like that for literally years and hadn't seen a move bigger than 3% for literally years in a day. This red line is called a 200-day moving average, and it's very important for people that like 200-day moving averages, because when it breaks either up or down, you have cracked a trend. As you can see, with the 200-day moving average down there, the 200-day moving average got broken quite substantially. And the interesting thing is that is classed as short-term vol. It's only affected one asset class, and yet it's turned the world into a tailspin. This isn't the end of anything. It's potentially just the end of stupidity, because now people are running around on eggshells. But it is no indication of anything other than all of this was garbage. It was stupid. Capital markets don't behave like this. And some pigeons came home to roost. We go back to Argentina's 100-year bond. That same page, doink, 9% off in a day. Now, Murky did a fantastic job getting this away, because the issuer doesn't care. He's banked his $2.75 billion. He'll keep paying a 7.9%, but the chuckleheads that bought this have now only got 99 and a bit years to go before it matures, and they're already down 9%. How good's that? And it affected equities too. This is from the 2nd of February this year. So these year to date is basically January. With the exception of the POMs and their criminal spawn, everybody else's markets were up. And in some cases not bad. New Zealand cheated because you're up 0.5% for the year, but you got more than 3 times that day. So you were underwater, but still part of the trend. And this was from Tuesday this week. You might notice the colour has changed. We're still up, sort of. The only other one that's up is the tech index in the US. The Chinese index, which was up almost 9%, is now down 1.4. That's not a bad little flip. And it's not surprising. I mean, this is what equity markets do. They just normally spread it out over a little bit. And remember the graph about the record number of people expecting equities to be higher in a year? Jom! And expectation is reality. Isn't nature wonderful? And just just in case you missed it, volatility has returned to markets after a calm 2017. That's 2017. That's February the 5th and subsequently. So, doink is where the markets went. And maybe, just maybe, volatility has got us thinking about risk again. Maybe. However, I think most people are probably a little bit like this. Oh my God. Oh, it's too late. Happy days. So maybe not. Moving on. What does the world look like? Is it going to be supportive of capital markets? That's a good question, Grant. Glad you asked. Let's have a look at some of the world leaders. We got Trump. We got Theresa, we got Malcolm, we got Jacinda, Merkel, Xi, who appears to be very unimpressed by the Speedos. So, taking a little whiz around, Trump's a disaster. Almost certainly the worst president in 100 years, possibly the worst president ever. We've got May having a little cry. She's hanging on by fresh air and hope, and that nobody else wants the job. Merkel's taken to drinking, essentially running a lame duck government. Turnbull is taken to swimming. He's essentially running a dead duck government. Our man down there is the new Caesar. Jacinda, still too many teeth, and appears to have a flat tyre on her training wheels at the minute. Who else have we got? Vlad is taken to murder offshore as well as onshore. Trudeau is still struggled to find a mirror he didn't like, and Abe just seems to be happy to be alive. You'll notice that there's no Italian leader on that board. That's because there's no Italian leader. So, who can we rely on? Funnily enough, those looking for peace, stability and good leadership now depend on the French and the Argentinians, who are both astonishing leaders and from the most unexpected places. Here's another question. We have seen a lot of young leaders on there. Last year, who was the youngest leader elected in the OECD?
Austrian guy.
Well, Jesus. His name is Sebastian Kurz. So Jacinda was 37. She could have been his grandmother. He was 31. Well, maybe not. And it's interesting. This guy here, married to his teacher. Wonder if that accounts for his success. On to debt. Debt's a fascinating thing. This is US household debt. It has just hit 13.15 trillion. It has now gone past its GFC high. Now, to put this number in perspective, that's $40,000 for every man, woman, and child, legal or illegal, currently living in the United States. That's a big number, yes? Where would that rank the United States on household debt per capita in the world? Surely it's first. That's why I've asked the question, because obviously it's not. Are they on the podium? If it was a rowing race, they wouldn't even be in the field. They are about eighth. Anybody want to have a crack as to who the top five are? New Zealand is one, they're second. Australia's first by miles. No. Canada's another. England's nowhere near it. So who have we got so far? Canada, New Zealand, Australia. The other two are quite hard. It is Scandinavian. Which one? It's neither of them, it's Norway. And the other one is a Central European country. And by central, it's landlocked. And it's surprising. Switzerland rounds out the top 5. So, the US is only about 135% of household income is household debt. New Zealand is coming up on 175. The Aussies are looking, and they'll probably get there this year, at 200%. Why does that matter? Why does that matter? Because the only thing that is certain on your balance sheet is debt, right? It's a number. And in Australia, in the next 4 years, $1.5 trillion worth of interest-only mortgages are going to be converting to principal and interest, which will, for most of those mortgagors, turn out to be a 40% increase in monthly payments. Now, if you're sad and tragic, you read the quarterly CoreLogic survey of consumers. I don't. I leave it to somebody sad and tragic to do, and then I read what they think of it. And the sad and tragic person is a gentleman called Jonathan Payne, who many of you have seen. And he noticed 18 months ago that this completely pointless, and everybody thought it was, a pointless survey. One of the questions was, how much would your mortgage have to increase it by to make it difficult to pay your bills? And the number starts from 0.25. It goes up in 25 basis point increments to 2.5%, and then it's over 2.5%. And traditionally, the average has been between 100 and 125 basis points, so 1 to 1.25%. Jonathan noticed that the number kept coming down. So more and more people were going for lower and lower numbers. The number for more than 18 months now, the average, or actually the median, is 0.25. 0.25. How good is that? 65% of Australians with mortgages say that a fart by the Reserve Bank Governor of Australia means they can't buy groceries. And they have got a 40% increase coming if they have an interest-only mortgage. And guess who's the only other country in the world with interest-only mortgages on that sort of scale?
New Zealand.
Hooray! No prize for that one, sorry. Total world debt. Now, remember that the GFC was caused by too much debt. So this is the too much debt, it's 142 trillion. We've fixed the problem by getting more into debt. And if you have a look at the percentage growth per year of that debt, it's way in excess of GDP growth, miles in excess. And this is slightly misleading because in the last 9 months, it's gone up 16 trillion, which is 7.4% by itself. As a result of the low volatility, everything mixes up, right? People have got fat and happy and they're borrowing to party again. It's exciting. It's good fun. Credit is cheap. Very, very, very cheap until you've got to pay it back. And the last equation on the real world that matters are the central bankers. They're aware of labour market tightening. That means that unemployment's falling. Tight labour markets mean higher wages, by definition, because labour is just a commodity, right? For the last 10 years, in the battle between capital and labour, Labor has been left in the starting blocks. It's all changing. Higher wages equals inflation. There's a very funny rule called the Taylor rule, invented by a man called Mr. Taylor, who's not only still alive, he is very likely to be the next deputy chairman of the Federal Reserve. He's regarded as a hawk because, oddly enough, he believes this because this is the Taylor rule. So the current Federal Reserve is telling us we're getting 6 or 7 increases in the next 2 years. Taylor comes in, you can lock 7 in and then start working your way up. He will do anything to get in front of inflation because he sees labour inflation as not just an indicator of future inflation, he says it is future inflation. He will crush inflation. So interest rates are going up. No question, because after all, central banks, that's their job, make people miserable. They're also aware that economies are on the mend, but they're fragile, but they are on the mend. They're aware that banks are looking to lend, theoretically. Haven't seen any yet, but apparently that's the case. They're aware that the so-called central bank put. So any time the US share market looked in trouble, Ben Bernanke, who was the chair for across the GFC, said soothing things to the market like, we're just buying an extra $500 billion worth of bonds. Go back to sleep. Everybody did. And they are aware now that what they've done has badly distorted markets, which is why we've gone from QE to QT. On to what might refreshingly be called a rant. Portfolio construction 101. Politics is stuffed. Debt's catastrophic and interest rates are climbing up. Credit is tightening, in my opinion, and the capital markets just don't care. I'm going to put it to you, you need somebody to call. And our theory on portfolio construction is pretty simple. Portfolios should do well in bull markets and bear markets. They should do well in volatile environments and sanguine environments. We believe in endowment-style investing. We believe in IQ arbitrage, which is very easy to believe in. We believe in real diversification. We believe in diversification of sources of risk, not the crap that you get peddled by the KiwiSaver providers. We believe in maths. Nobody in financial advice in New Zealand can spell maths, let alone believes in it. And we believe in risk analysis. We don't believe in fairy tales. We don't believe this time it's different. We don't believe in going with the herd. We don't believe in heuristics, prayers, strategies based on set and forget, buy and hold, or lay down and die. Anything that even resembles an idea like that. We aim to make money by not losing it in the first place. I still think that the best year we ever had was 2008. We were down less than 21%. The average New Zealand balance fund was down 45%. Coming back from 45% down means you need to go up by about 100. Coming back from 20% down means you've got to go up by 25. It's pretty easy. We believe that risk should be defined as anything that could cause permanent loss of capital, and that it should be avoided as a goal and ameliorated as a minimum. You do this and the upside looks after itself. Remember, the only way to make money is not to lose it in the first place. We believe that humans are prone to biases, particularly recency biases and their first cousin, confirmation bias. If you've ever met a dairy farmer, you will find that they think that the most recent high price that they got is the basis that they can then extrapolate expenses and earnings from out to infinity. It's astonishing. That is a classic example of not just recency bias, but also extrapolation. We believe idiosyncratic investing, I'll touch on that in a minute, generates real returns in any market condition. But we are aware that most people either don't believe that, don't understand that, or both. We believe that trends are our friends and efficiency are a godsend, and the brain speaks bullshit all day, every day. So an example or two. Why do we like trends? Let's go for the big daddy of trends, demographics. Why is demographics important? Anybody know who Willie Sutton is?
Bank robber.
Bank robber. When he'd been arrested the third or fourth time, he was famous. I mean, his books are a rollicking read. It's pretty simplistic, but it's a good book. They said to him, Willie, why do you keep robbing banks, man? And he said, Nev, that's where the money is. Demographics is the trend in the world where the money is. For instance, it's expressed in lots of ways. Infrastructure, which can be defined as for the public good. Basically, you're betting on urbanisation, you're betting on trade, you're betting on tourism, you're betting on everything when you bet on infrastructure. It's the only asset class in the world that is both a deflation hedge and an inflation hedge. And it's not even an asset class in 99% of portfolios. It's not mentioned as an asset class. The greying of the West at the moment, but the world soon. Mortality, the chance of getting dead, is falling at every age, and morbidity, the chance of getting sick, is rising at every single age. Sicknesses that used to kill you now don't. Healthcare. Those that saw COG will understand why this is a good idea. It's way more than 20% of US GDP. It's a huge portion of everybody else's GDP. It's basically unrepresented in portfolios. It's very hard to buy this in liquid form. You can buy Merck and other big pharma, and that's more or less your lot. It has real inflation. So the interesting thing about healthcare inflation is that it's between 6 and 10% above CPI in basically every country in the world. That's why you scream and shout at your doctor and your surgeon and everybody else and your medical insurer. It's why nurses are chronically underpaid, because they've got to save money somewhere. It's a grossly inefficient investment environment, grossly inefficient. And it's underwritten by governments. The reason it is, because as Longer used to say, if you have people dying on the street, it's bad for tourism. The trend to rent. Who would have thought? The average rental time in the US in 2000 was 6 months. It's now 6.5 years. That's a 13 times increase in 16 years. And that is likely to continue. There's people in here that own the multifamily funds that we've used. That's a play on that. Education. It's the biggest service export in many countries. In Australia, education's likely to pass iron ore and coal in the next 5 years and be its biggest exporter by itself. Frontier markets. This is Africa, the Stans, Far Eastern Europe, the Andean countries, Argentina, Southeast Asia apart from Thailand, Malaysia and Singapore, Sri Lanka, Bangladesh, those sorts of countries. Why? Fastest growing, starting from a low base, infrastructure spending going in, youngest demography in the world. The median age in Africa is what? Anybody got any idea?
19.
It was 19 in Nigeria, so that's the biggest country. The average is 23. 23. Idiosyncratic investing. This is a payoff example. For every dollar that you might lose, you need to know you're going to make at least 3 or 4 in these sorts of investments. Buy debt risk, get equity return. COG again. Distressed investments. People say, why would you buy a distressed investment? Why wouldn't you buy a distressed investment? The assets often get in trouble. Owners more often get in trouble. Regulatory issues force sales. There's all sorts of things. It just goes on and on. Monopolies, which you can't say anymore, so we call them differentially advantaged assets. It's most patronage infrastructure of monopolies. Opportunistic situations. We've just had that with Blue Sky. Something that was far too expensive then became far too cheap. But because of the work of somebody else. There are opportunities that are hidden in plain sight. Everybody know what GSEs are in the US? Anybody for a book? Tell me or give me an example of a GSE. Goodness gracious. So Fannie and Freddie are government-sponsored entities. They're the biggest mortgage providers in the world. They got put in conservatorship. They've been trading profitably now for 7 years, and they're still in conservatorship. You can buy their notes at an 80% discount. You need to have a way to buy the notes, but you can buy these notes. An 80% discount to par. First mover. In my industry, we have things called research houses. They won't look at a new manager unless they've been alive for 3 years. The best hedge funds in the world are generally closed before they reach 3 years. So you back brilliance, you back ideas. Because being first mover might be your only chance. You find investment opportunities that somebody else has moved first on. The multifamily thing's a great example. They were the first guys in the market. They were the only guys there for over a decade. Their first fund paid out 28% IRR. The current fund that some people in here are in will do about 22. The one they're promoting at the moment, they're looking at getting 15. It's because more people have come in, the market's become more efficient. It's worth finding first mover. In special situations, arbitrage situations. Inefficiencies. People pay too much for liquidity. Way too much. There's nothing wrong with illiquidity. What there is wrong is misjudging how much illiquidity you can cope with. But the illiquidity discount is always too big. People don't recognise their biases. You can take advantage of that. Recognise that people don't think. You can take advantage of that. Recognise that people can't do arithmetic, let alone maths. You can take advantage of that. It's just common sense. Recognition that inefficiencies will eventually close. Never fall in love with an idea. Eventually it will it won't last forever and it will become efficient. So to summarise, a lot of our best ideas fall into 2 or more of those buckets, by the way, and often into more than one sub-bucket. Our current favourites, healthcare, it's a debt instrument, it's producing double-digit returns, it's illiquid, pays income, it's basically one of only 2 players in the market, and seen its pipeline of opportunities because they've proven they can do it double in less than a year. but eventually that'll become normalised. Long-only capital markets been spectacular for 8 of the last 9 years, almost anywhere. Australia's a notable example. Brainless beta, animal spirits, whatever you want to call it, has overwhelmed common sense, intelligence and analysis. It had to finish, it's done. You want to be unhedged, naked, long-only capital markets, help yourself. But exposure to, in that way, to either equities or fixed interest today is not just illogical, it's dumb. The real world is an exciting place to be, but it's fragile, it's uncertain. It is very different to the world of 2010, when we were coming out of the GFC, and blind faith in the wisdom of crowds to assist in your navigation doesn't seem like a sensible approach to me. After all, it should be remembered that forming an orderly queue and marching off together to the gas chamber just because others are doing it has historically not proven to be a winning strategy. Sensible, intelligent portfolio design with a sensible time frame will create good returns. That's never changed. The easy money from markets has been and gone. The markets look to me like they did at the end of 93. We had a blow up in 94. 98, late 99. We had a blow up in 2000. 02, which was a horrible year that nobody except Neville and Norman and I probably have got any idea about. And 07. Despite what happened to the capital markets then, this is an environment when you can make money, very good money. We have been here before. Any questions?
Who wins the last book?
That's a good question. Who is currently the acting Prime Minister of New Zealand? What's that? Back to my good friend Jeremy. Spin. Any questions, comments, abuse?
You haven't mentioned gold or all those sorts of things.
Haven't mentioned gold, haven't mentioned cryptos. They, and the reason is that they should function as they function in any environment. So that, to me, there's nothing special about what's happening at the moment. Gold is often called a deflation hedge and an inflation hedge. I think it's probably an inflation hedge. I doubt it's a deflation hedge. It is also a commodity. I think there is no issue at all in having an exposure to precious metals, platinum, silver, gold, yada yada. Cryptos are a different kettle of fish. The regulators are the big danger for cryptos. Their big advantage was that they're not fiat currencies. When Venezuela and Russia issued a fiat crypto, the people that were going to lose from that spreading were the Chinese and the Americans. I think you'll find that the best hackers in the world work for the Chinese and the American governments. That's a problem for crypto. If they start to regulate it, and the pressure they're putting on is working. They've affected South Korea, they've affected Japan. So regulation will spread. No other questions? Cool. So, thanks for coming. We hope you can stay for a drink.